Okay, let's go ahead and get started. Welcome all. Thank you for joining us for this webinar. Is a touchless app really achievable? So we've got three panelists today, and I'll start with David Tross from Nortech. So David has over 8 years experience spanning the equipment finance industry. He's built solutions for brokers, independents, lenders, and regional banks. Through his career, he's held leadership positions in sales, syndication, and product management. David is passionate about harnessing technology to automate complex processes and deliver innovative solutions. And then we have Lynette Bolsier. So Lynette is the VP of Origination Management at Great America, the largest privately held equipment finance company in the United States. She oversees the personnel, processes, and technology for processing credit applications from intake through to funding. Lynette has been with Great America since 2001, starting as a credit analyst, transitioning through various operation roles with increasing responsibilities. So as you can tell, she's got a wealth of knowledge that she'll be able to contribute to this dialogue. And then we've got Jordan Segusa. So Jordan is an industry veteran with a proven background in developing and executing successful business strategies, leading cross-functional teams to maximize efficiency and exceed financial objectives. Jordan has held leadership roles in sales, capital markets, and was a founding member and chief operating officer of two Monitor 50 companies. So as you can tell by their background, they're well suited for this discussion. So maybe to start out with, I'm going to hit them up with one quick question. So Jordan, is a touchless app really achievable?
Hey, Christian, thanks for having me, by the way. Yes, I think a touchless app is achievable. However, as in most things in life, just because you can do something doesn't mean you should do something. But we'll get into that probably a little bit more along the line here today. But 100%, in multiple industries, it's not only achievable, it's doable, and not as difficult as many may think.
That's great, because I was worried about your answer. It could have been a short webinar if you said no. So, Lynette, what are your thoughts?
Yeah,
Is it doable?
absolutely. Absolutely. I'm right in line with Jordan. And, it's one of those things for a lot of people, seeing is believing. And if you think about your processes in the current state, it's going to be really easy to say there's no way I can automate that. So there's really an element around reimagining your processes to make the automation possible, as well as just understanding sort of what niche you want to automate in. If you think about everything you're trying to do, it may not be possible to automate 100%, but there's places you can absolutely do it.
Great. Looking forward to unpack that further, Lynette. And then David, what are your thoughts? Have you seen it doable before? What are your thoughts?
Yes, definitely. So I've seen it in practice as well as in theory at Nortech. I mean, we're trying to build automated touchless credit solutions, which is why I'm here today. So it'd look really bad if I said no. But I think, one thing that we'll touch on is how difficult it actually is to build a touchless credit process. And there are different starting points you can take along the way. So it doesn't have to be this big nebulous thing of you need a huge investment and a lot of money in order to deliver a touchless credit experience. There's different ways to jump into the automation process.
Yeah, well, great. Thanks, guys. And to give a little bit of context, so when we say touchless credit app, we're really talking about an automated app through signed docs without the lender touching it. In other words, can the app come in, go through credit, do fraud checks, go through docs, get out for e-signature without somebody actually performing tasks? And we'll unpack those details coming up. So as you guys know, automation has become absolutely essential for a number of reasons. For driving operational efficiency, for mitigating fraud, for creating amazing and borrower and vendor experiences, and enable lenders to scale. So in this session, we'll talk about some of the core challenges with enabling automation. We'll share real life examples of fraud, and we'll share strategies to overcome some of these challenges. Okay, preparing for automation. So as we begin our discussion on automation of the loan origination process, let's start with one of the most important fundamental aspects of it, and that's preparing. I mean, you can't just jump in and do it. So in this set of questions, we're going to be laying a solid groundwork. It's going to involve examining current workflows. We talk about identifying bottlenecks and understanding where automation will have the most impact. But beyond these steps, selecting the right tool and platforms can be critical. So I'm going to start out the question to Lynette. So Lynette, from your experience, what are the foundational steps do you recommend before adopting automation in loan origination?
I think the very first thing, and Jordan might have mentioned this earlier, is you can absolutely automate. And what you need to think about is what should you automate, right? You need to understand where your customers, where your prospects see value out of your organization. And there's going to be places where your customers value that human interaction. And there's places where they're saying, boy, I don't really need to interact with a human. This is something I can do on my own. So I think it's really understanding the value that you bring to the market and making a decision there where you want to approach automation and where you really want to maintain that human touch. That's the very first place I would start.
Great. Jordan, do you have anything you want to add there?
Yeah, I would add absolutely 100% agree with what Lynette said. But from a fundamental logistics standpoint, if you're looking at your underlying process and understanding kind of what that process looks like today, there's usually room for opportunity and improvement when you leverage automation tools, but just because you have the ability to automate something doesn't mean you should. I found a lot throughout my career, people kind of digitize manual processes and you end up with just a faster version of what you had before, which was maybe not effective or efficient. So, really breaking down your workflow process and understanding the touch points, both internal and external, what inputs are required and what the expected outcome is. Additionally, the handoffs, from team to team, understanding what's involved and what data is required to make the next person in line in the workflow be successful. And then, I think evaluating controls and validation points throughout the process. There's a lot of opportunity for automation, leveraging automation in those different handoffs, controls, and validation points.
Great feedback. So what I'm hearing is that really taking a look at your processes, using this as an opportunity to even understand why you're doing them. Like, should you even be doing them in the first place? Is it ultimately adding value to the borrower or vendor before you just try to go automate a process that shouldn't exist in the first place or is happening in the wrong way? So, David, want to get your thoughts on at what point do you identify where humans should be involved through this analysis? When should a human jump into the loan origination process?
And I think Lynette and Jordan touched on it in their answers, but there's basically 2 points. So one is when the business decision makes sense, when there's value added through a customer service touch point, where the end user is actually looking to interact with a person, but also when you don't have the depth of data to automate the process to 100%. So things like credit exceptions, or when you want to do a manual review on a fraud check, making sure that you have an analyst who is monitoring the process as a whole, but is also willing to and able to jump in when the process goes off the rails.
Great feedback. Lynette, Jordan, do you have anything you want to add to David's comments on when humans should be involved?
I think one of the things to think about is if you're going to throw a human into the middle of an automated process, they really have to understand what's come before them and what is going to come after them, right? It's different than, I'll call it the old days where you had, paper files that you were handing from person to person and you had that soft handoff where somebody said, hey, here's what I've done on this transaction. I'm handing it over to you for these purposes. Somebody's going to have what had been previously an automated transaction drop into their queue, and they're going to need to be able to dig in and understand what the automation has done, how that particular transaction landed in their queue, what they need to do to get it back on the automated pathway, and understanding the downstream impacts of what they've done. It's a different skill set than I think what we've hired and trained for in the past.
Great. Okay, let's move on. So we're going to be talking about the vendor and borrower self-service. So touchless applications means a lender's not touching the application, including having a lender key in the credit application. So will a borrower or vendor be willing to do this? Are things to consider. And what other touch points are there between the vendor and the borrower? For example, adding pricing and quoting up front, or post credit pricing if you're doing risk-based pricing, closing out credit stipulations, requesting documentations, which we'll go into further. So those are all things that you can engage with your borrowers and vendors. So Lynette, I think it's, what we've heard, we've all probably, anyone who's been in the industry long enough knows that, we made a big investment, you build this big vendor portal, you roll it out, and nobody uses it. And then there's the question of ROI. Well, why did we go through all this effort if we're still getting, emails and faxes in some case, credit applications? So from your perspective, how do you incentivize or encourage vendors and or borrowers to take more active role in the self-service?
Now, I think the big thing is, number one, just awareness of the technology that's out there. I think sometimes we live in a world of, if you build it, they will come. Well, it's more like, if you build it and you help them understand the value to their process, then they will come. So I think there's certainly a marketing play there, as well as your frontline operational team members understanding the value and being able to talk to the customers on a regular basis to say, hey, that's great that you called me to put this credit application in. Did you know that there are 5 other ways that you could have done that without calling me? And you could have done that 24/7. So I think the awareness is a really big thing, in tying that back to the customer's goals, or the equipment vendor's goals, in terms of how they're trying to drive their sales process, move more equipment. And if you can really tie it into their process and show them the benefits, show them that it's decreased turn time, a better experience for them, that's how you're really going to get them there.
Okay. So when you said help them understand the value, what you just said as far as reducing that turn time and getting their equipment sold more easily and frictionlessly. Do you, when you said tie it into their process, help me understand that a little bit better. So it's not just a matter of you throw up this portal and say, start using it. That's not tying it into their process.
Not well. So if you don't understand their sales process, and you don't understand where the financing component comes in there, you don't really know what kind of benefit they're going to get out of what you're building. And, everybody's going to have just a slightly different sales process, but, generally speaking, they're out there prospecting, they're putting proposals out there. They might be demoing equipment, but understanding where that financing fits in and how that expedites their sales process is going to be huge. Because as you said, when we're talking about touchless, it's touchless from application intake to that document signing. So where they get that agreement signed, that essentially gets the deal off the streets for them. And if you're in sales, that's like the number one thing. You want to get the deal off the streets so that your competitor, when they call into that same account, right, you want that borrower to say, gosh, I wish you would have called last week. I just signed with so-and-so a week before. Even if they don't have the equipment in their possession yet, they're going to decline a competitor calling in, because they're going to say, I just signed. And so helping understand where that fits in the process and how they can expedite getting to that point in time is going to be huge for the equipment vendor.
Sure. So you shared some experience offline, Lynette, and I'd like to hear, your guys' thoughts on kind of frustration on self-service, right? Sometimes you'll be working with, I think we all like the Amazon experience and be able to click one click and you've got an item being shipped to you. But then when you go off that standard path, sometimes it can get frustrating. So, David, I don't know if you've got thoughts on this, but what are your thoughts about how to minimize some of that vendor and borrower frustration that can happen in an automated process?
Yeah, I think it's building the user experience for self-service to accommodate and help explain what's actually going on in the process along the way. Um, so that the borrower or person inputting an application knows why things are being required of them, setting up some guardrails on what's going to happen next in the process so that you're creating a good foundation for expectations on what the overall credit experience is going to be. From there, you're able to train customer service people on, this is the process, here's the tools that we're giving to our vendors or providing to our borrowers so that they know what is happening before and after an action is taken by the actual user, so that when a customer service inquiry comes in, they can quickly respond and help put them back on the happy path. One thing that I've seen come up a lot, especially in sales-led relationships, is the most important deal is the one that is happening right now. Sales organizations tend to have a very short memory span, and they're focused on hitting monthly or quarterly numbers. So it's really important if you do have a bad experience with, or a borrower does have a bad experience with your application process, that you can quantitatively show over time that you're delivering a better experience by asking for additional information, or showing the benefits of automation at a much bigger scale versus just doing a he said, she said on the current application at hand.
Yeah, that's consistent with what Lynette was saying too. So, Jordan, what
Yeah.
are your thoughts on this borrower vendor self-service?
Yeah, sure. I think that both Lynette and David touched on something that's critical that sometimes is overlooked. It's the when something falls off the rails, right? Automation's great, technology is great when it works, but it doesn't always work, and for obvious different reasons, right? I had a client that had a super awesome online portal to collect application data for borrowers, but they're having a problem with incomplete applications. And when you have a borrower going through a process, they need to, first of all, they probably only want to do it once. Secondarily, if it doesn't go through, fortunately, this client had a great process in place to capture partial data and capture that in a way that where a person would then reach out if there was incomplete information. So the borrower never wondered if whether it went through, it didn't get through, and nothing fell through the cracks. So I think the punchline there is that, even if you have great automation, cool processes, often you should and will need to have some type of backup plan and some human interaction, either to smooth over rough edges or to catch the automation where it didn't complete the task that it was intended.
Yeah, that's great feedback. I mean, you had a couple of great nuggets in there. I think one is figuring out what type of data is needed up front, because borrowers, vendors only want to type in the data once, right? Like, so, is this an app only deal? If it's not, if there's certain data points needed, making your process and system smart enough so it tells them that, which I think is key. But the other thing that you mentioned was when somebody exits, like somebody's like, maybe I don't have the data need, and they exit that, being proactive, like what we said, the human engagement, that's where the human engagement comes in. They clearly started an app, they didn't complete it. How do you engage with them? So great nuggets there. So thank you. Let's move on to the next topic, which is a tricky one, and that's credit automation. So this is critical. So vendors and borrowers expect quick decisions, right? I think as consumers, we're used to applying for credit cards, car loans, things like that, and getting almost immediate approvals. And I think that clearly has moved to the commercial side, especially for the app only deals, right? Like if you're financing things under 250K, I think the expectation is that you're getting decisions, if not immediately, shortly afterwards. And implementing automation and scoring, lenders can expedite these credit decisions, but it's tricky. There's a lot of complexities to building these cards, and And there's also a lot of value in creating scoring systems to allow, like, I think, Lynette, you mentioned, like, where do people add value? And on the credit side, they probably add value in that gray area, right? The ones that are not obvious approvals and obvious declines. So let's talk about some of the challenges here, which include, collecting data. David mentioned that earlier, like getting all the data you need to make that decision. Well, how do you find that balance? That's a challenge. How do you even develop a robust scorecard? I mean, you have different products, you have different collateral, you have different borrower types. So how do you build a comprehensive scoring scorecard or scorecards? And then how do you automate the unusual scenarios, like a flower shop financing a bulldozer, right? Like, where does that come in? So with that said, maybe we'll start it out with Jordan. Jordan, balancing speed with accuracy, with a push for faster credit decisions. How do you balance the need for speed with accuracy and thoroughness?
Yeah, I would start with just the statement that, it's not, there's no silver bullet, generally speaking. Every business, their model is, it's going to be, circumstantial as to what they can leverage from an automation, from a scorecard standpoint. So my recommendation would be, you start small. Or if you have a highly homogeneous type product, if you have the data, then you need to look at your data as far as what the human decisions ended up with. And if you can correlate those decisions to portfolio performance, again, with a homogeneous type portfolio, then it's a kind of an iterative approach. There are plenty of service providers out there that sell you data that will help you build different models and evaluate different models. So I would definitely recommend to leverage the resources that are out there and are available. But I think the first and foremost is like kind of start small, test your data, and make sure that you're open to an iterative approach to making adjustments along the way.
Great. David, what's your thoughts? You got a fair bit of experience in this area. What are your thoughts? Is how do you find that balance between speed and accuracy with your scoring?
Yeah, I think as Jordan mentioned, like the foundation for this is quality data and good data hygiene. So there's this the need to have lots of historic data in order to build a scorecard or go buy data. But then when you actually implement it into practice, you want to make sure you're getting the most out of your scorecard by feeding it the right information that a deal is legitimate. So instead of taking a shotgun approach on data advisors, the data providers, and pulling 5 different data providers at once, one thing that I've seen that's helpful is waterfalling your data providers and pulling cheaper ones first to validate identity or fraud. Even when an application is inputted using address verification, so that by the time that your application reaches the credit stage, you have a high quality deal that you're confident is legitimate and the data is correct, so that you can ensure that your scorecard decision is going to be accurate. And the other byproduct of this is you're actually making your underwriting process cheaper by using cheaper data providers in advance to kick out deals and kick off that manual review, human intervention process when a deal doesn't meet the cookie cutter or mold that you're automating against.
Yeah, that was a key nugget of information there too for the audience, is setting up these credit waterfalls is, I think, an industry term, and that is, knowing that, like, when to exit out of the automation, because some business reports can be expensive. Business credit reports can cost $40 or $50 a pull. So if you can spend a quarter to know that maybe you've got a fraudulent deal or some outlier, or you spend a few dollars and get a PG credit report that falls outside of your window, the sooner you know that, you can not only make your system run faster, but like you can avoid spending a lot of money, which I would imagine is a big risk with automation, right? You let this thing run, you can start getting charges quickly. So great feedback there. So Lynette, as far as, like, you've got the scorecard, it's running, and I know I'm going back to your credit days, but so you've got the scorecard, it's running. Like, what are some best practices you found in in defining them in the first place, but also refining them as you're going along.
Yeah, when I think about defining, first of all, if you're using an existing scorecard that maybe isn't automated, I'm going to go back to the why. Why are you looking at that data? Why is that crucial to your credit decision? So whether you're using a scorecard or whether you have credit analysts manually doing the work, understand why you're using that data. What are you trying to perceive about the borrower with respect to that data? Because then you're going to have to figure out, is there a way that I can get that data in an automated fashion to bring that into the scorecard? Sometimes the answer is going to be no, and you're going to have to sort of go back to the drawing board and say, is there some data that I can get in an automated fashion that I can use as a proxy to understand this piece about the borrower? So that's what I think of when I think about defining. When I think about refining, monitoring, like you just need to understand, when you look at that scorecard, is it performing the way you think it should perform? You might see a drift in there, and it might be due to your scorecard, but it also might be due to your borrower profile as well. And you really want to make sure that your scorecard is keeping up with the profile of the borrowers that you're looking at. And that monitoring to know, is the automated process working the way I would have expected my human analyst to operate? So in the same way, you might have a credit leader that is coming in over the top and looking at some decisions that a human made. You're going to want to be able to come in over the top and look at decisions that the model made. Now, I'm not saying that we want to second guess every decision the model made, because part of that is letting the model run, let it work, right? We are not in a business of zero losses. We are in a business of managing losses. So your model isn't going to catch everything for you. And I had shared an example sort of back in my 2001 days. I took a loss on a deal because the model didn't catch that it was a .com. And I just remember my leader saying to me, Lynette, you got to let the model run. Otherwise, we're going to never know how well the model performs. So monitor, but also let the model do its job.
Yeah. Jordan, I saw some head shaking there. So
Yeah.
it looked like you're in agreement. Do you have anything you want to add to the monitoring and refining discussion?
Specific to trusting the model and trusting the data. I had an experience when building out a scorecard a number of years ago as well, and it was looking at thousands of booked transactions and doing kind of like a retro analysis on those. And when you applied the scorecard model that fell within the credit risk profile, we found that in the actual portfolio performance, the deals that fell within the model performed better than the human analyst who tried to enhance the deal by getting more down payment or shortening the term. Across the board, the model predicted that those deals were going to default, and they did. So I'm sure it's again, there's no silver bullet, but my point is that trust your data. You smart people who come up with the model. You got to trust the model has got some legs to stand on.
Yeah, that's really interesting, because you do hear that often, that higher risk, shorten the term, kind of like try to work it so you can override that model, and clearly it backfires sometimes. So David, on the reverse side of things, when is human judgment crucial? Especially with the data, we've got this automated process, it's running. At what point do you involve humans into the credit underwriting process in regards to scoring and credit?
Yeah, I think there's sort of a big picture take and a transactional perspective. So you should have monitoring and reporting set up on the scorecard to ensure that it's performing a certain way over time. But you still need to have credit analyst input to help analyze that data if it's underperforming, and if there's a certain subset of transactions where there are factors where you need to look at sort of de-automating. So it could be like used equipment is the model performs really bad, so we need to bring an analyst back in to help evaluate what's going on there, and help refine the model further. I think on an individual transaction level, there's a lot of it has business case implementations, or is business driven. So especially for deals that are borderline, through the scorecard. So you need to evaluate whether or not the risk of an exception or a deal potentially going bad is going to have an impact maybe on an overall vendor relationship. So do we make an exception in order to prioritize getting more volume from a vendor or a customer that has a high probability of coming back as a repeat customer if the um, deal goes as intended? Um, yeah, I mean, I think those are the main ones that I've seen.
Great. Thank you.
Yeah,
You know,
Chris,
there's a lot of,
sorry. I was just going to add something to that. I don't think you ever eliminate the human interaction. If you're, unless your stated objective is to do that, which I think is not the typical objective, right? You're trying to get as much lift as you can leveraging technology. So if you're doing 100 deals a week and maybe set your goal that we want 50 deals to fly through the scorecard so that those 50 deals that didn't fly through, we can reallocate those human resources to make better decisions and provide a better experience where it's quicker, more effective use of people's times. You know what I mean?
I do know what you mean. And I think we see that with our clients where, we will develop a scorecard and maybe the goal is 50, but start with 5%, start with 2%, start with 0%, see how it performs, and then slowly increase it over time, create that middle, so the gray area is much larger to begin with, but you start shrinking the gray area on the positive and negative side over time. So, one thing that you guys said, which is a challenge for some. So, and I'm gonna kind of throw this back at you, Jordan, because I've worked with you on a few occasions with new businesses, right? And there wasn't a lot of data, right? Obviously you're a new business, you're starting new originations, you don't have the data. So for the folks that are listening that are in that situation where they're like, well, that's great. Yeah, go look at a bunch of data, but I don't have that. So what am I going to do? What is your recommendation for those folks starting out that just don't have the data to do the analytics to develop a scorecard?
Sure. I think uh, we touched on a little bit, but reiterate, right? Start small. Any lift that you can get leveraging the tools that are out there is going to be a net win, right? And if you start small, make sure that the data that you are collecting data appropriately, accurately, and in a usable form, so that as you continue to have more history under your belt, you can start to take bigger swings towards the fence. I think that the outcome or the immediate benefit of automation doesn't necessarily mean to be auto decisioning. It could be just leading you to a more sound decision and a higher level of comfort on the decisions that you're making, even if you don't have that historical perspective to see how it compares to what humans have done in the past. Does that make sense?
It does. Yeah. I'd like to unpack that. I'd like to have a whole session on credit, but we got to move on to fraud. So, all right, we're talking about automation, and we're also talking about a post-COVID world where we're doing a lot more digitally. There's a lot less face-to-face, and we're trying to automate. And because of that, we're seeing a big increase in fraud. I mean, I think we're seeing statistics like you see on the screen, but we also there's fraud reports and that have come out numerous times over the last couple of years. And this is first party fraud. This is identity theft. There's and so we're trying to like automate things, but also catch the bad guys and fraudulent applications come in. Now there's a number of tools out there. There's biometric verifications. You can validate documents. You can track people's behaviors. But there's also more nuanced checks that you can do to, flag, have red flags on deals. So, so Lynette, in regards to automation and the touchless app, what are some of the when do you take in deals and bringing in people to look at them from fraudulent activities? What sort of things are you seeing in applications that would flag somebody to jump in and have to review whether there's fraud involved in a credit application?
You know, I really love this question because we spend a lot of time and, you know, just in business discussions or on webinars talking about human versus automation. This for us has been such a great opportunity to have our team members influence where we should be putting human intervention into applications. So I'm going to go back again to understanding your processes and understanding in a manual world, what are those red flags that your credit analyst would see that would cause them to dig in, ask some more questions, do some additional research. You know, you mentioned earlier, Christian, a flower shop wanting to finance a bulldozer, right? So you may have something that's looking at a SIC code against an equipment type, right? You may have something that says, I've got a construction company located in an apartment. You might see something that says, I've got a business that says they've been around for 20 years, but yet their address ties to like a UPS store. And those are all things that your credit teams are looking at. They're catching those things, they're doing the additional work, but there's tools out there that can do that for you. And it can't answer the question of why is the flower shop wanting to finance a bulldozer, but it can answer the question of, should I allow this application to stay on the happy path, or do I need to kick that out for a human to look at? So I think, you know, it's a similar concept with scorecards. This is really an opportunity for your really talented team members to influence the path of automation and feel like they really have a voice in what's automated. And then that also in turn helps them understand when an application comes off the happy path, how did that end up in my queue and what do I need to do to mitigate that risk? So great opportunity to blend the humans with the automation as you're setting up those fraud detection pieces.
Yeah, no, that's great. So David, I've got a challenge for you. I would like you to talk to the audience about what type of verification tools can be most effective. And my challenge for you, that's not the challenge, is try to do that without using a 2-letter acronym.
Oh, okay, sounds good. Can I
You
just
can
say the
if you
whole
have to. You
word
can,
instead? Okay,
you can if need be. It's not a technology webinar without it. So
sure. So, I think there are a lot of tools that help enable the fraud process today that use AI. So, tools like TruePick, who is using AI to help validate that virtual site inspections are done correctly, or um, biometric tools that allow you to hold up a driver's license and take a selfie and validate that both of them are correct and that person's in the right place in the world and their face matches what's on the driver's license. I think when thinking about the best tools to use for a specific process, it starts again with the user experience that you want to achieve and how you want to apply friction in that process. So one thing that I've seen over the years is uh, people try and implement flat and indirect channels, which requires a end user to connect their bank account in order to validate the information that's in there. Where Aqualus or a company where you might actually want to get those physical bank statements makes more sense, even though it is a different process that actually requires someone, to download bank statements. You're more likely to get them over, and you're still applying automation by still validating bank statements, just in a much different way. I think when you think about in general the best vendors, it's more of an ecosystem approach and how you can layer different vendors together, especially collecting the same data points from different vendors in a different way to help build that identity picture and ensure that you're okay with automating the validation process. I mean, having one point solution lender say this person is who they say they are versus 3 is just a much different level of comfort and provides a much higher level of accuracy.
yeah, good points. Jordan, you've held multiple hats through your career. You've seen things evolve. What thoughts do you have on fraud and technology options in regards to automation? This isn't a fraud session, but what are tools or things to consider when automating to prevent the bad guys from defrauding you?
Well, this goes a little bit off script here, Christian, to the point of automation, but maybe we can figure out how to bring it back in. I think that I don't want to sound Pollyannish or naive here, but this is where the people portion of your doing business comes in, especially if you're in the vendor space. I think qualifying your vendors is a key component of it, right? Understanding how they do business, like Lynette was mentioning earlier. If you have a risk aversion to vendors that sell online, which then we would have to dive into this automation and fraud protection, well then make sure you're doing business with vendors that align with your business model. And I think that human element for point of sale financing probably is a much lower risk business than the alternative where their vendors are not actually physically transferring goods and services with people that they're meeting across the desk. So I think you can leverage for evaluation of new vendors, a lot of different technology solutions for your due diligence, for monitoring, for portfolio monitoring. But the whole industry of fraud is just that. It's an industry. It's ever changing. It's changed considerably in a very short period of time. And I think that to David's point, yeah, you got to stay abreast, and you have to know who the suppliers are that are helping to solve that problem, and staying ahead of it by maybe working with multiple different types of data providers, vendors.
Yeah, I think that's key, right? I mean, it's a cat and mouse game, and it's ever evolving, and you can't be stagnant. And so uh, this is not a session on software platforms or anything like that, but I think that's key, right? I mean, you do need to stay ahead of it, and there's third-party tools to integrate to do that, and just make sure whatever you do, you're in a position to integrate new providers to do what both Jordan and David say, and that layering in options. So, well, let's move on. So much more to unpack with fraud as well. We could do a whole nother session just on fraud automation, but let's talk about docs. So, gosh, this is an area that we hear over and over from our clients that they feel they could provide so much lift by automating documents. However, it's one of the most challenging. And it's not necessarily challenging from a technology standpoint. It really seems to be a challenge from a process and a rules standpoint, because we all know the one docs person who's got 20 years experience, knows exactly what language and templates need to be created for a FMV in California, and with 3 PGs, and like all that's locked in people's head, and it's so hard to get that out. And in fact, often it's a project in and of itself just to define what the rules are. So with that said, having different legal language based on state, based on product type, based on the type of equipment you're financing, things like that, it becomes really tricky. So on that note, Lynette, you got all these rules, from your experience being in operations, how do you do that? How do you how do you go from this all being locked into people's minds into a system that can generate it? And then it'll be a two-part question. Have you found that there's certain documents that can't be rule-based, like it really does require a human to define, or do you feel fairly confidently that you could get rules all configured into the system?
Do I think you could get rules all configured? Yes, but what a monstrous undertaking that would be. So I'm going to go back to things that I think all the panels have said: start small. So just really start small. If you think you're going to automate every document, every transaction that flows through your organization, you're nuts, you're crazy. But understand what you can automate. And when I think about automating documents, for us, there's elements that we've got to consider. So one element is the customer. So what's the program, or the equipment vendor, what's the program that it was sold under? One other piece is end user attributes. So if it's a municipality, obviously, you may need to have a non-appropriations addendum in there. And then the third element is the attributes of the application itself, which includes things like, equipment, transaction type. Is it a fair market value? Is it a conditional sale? So when you think about pulling all those elements in to start, you're going to want to start pretty simplistic there. So you don't want to start with an equipment vendor that has a really complicated program. You may choose to kick out states that require state disclosures. My apologies to anyone online from California. You may choose to kick out the entire state of California for multiple reasons. But it's making those conscious decisions about where you think you can automate and just take that next step forward. But again, that tribal knowledge that's in somebody's head, you've got to understand the why behind that. You got to say, why does that individual care about the state in which the equipment's located? Why does that individual care about the entity type? Why do I care that it's a municipality? Getting those things out of people's brains is what really helps you understand where you can take that first step.
Yeah, that's a another great nugget to give to the audience, and that's very similar to the credit scoring, right? You might start with a small window and then grow from there. Identify that EFA for like a non-disclosure state for like a standard corporation type, right? Like a very vanilla type deal. Start with that before you kind of jump into the muni deals in disclosure states. So great suggestion there. So Jordan, on the same note, like what are some of the biggest challenges you've seen, and how have you overcome them?
Yeah, I think the data is key, and not just collecting data, collecting the correct data at the correct time in the process. So making sure that you have those, required fields being populated early on in the process, so that when the time comes to documentation, you're trying to evaluate whether or not you can do an FMV in a certain state because of taxation. You've collected the equipment location, you've collected the purchase option type, so on and so forth. Because as that handoff occurs, if you don't have what you need to do the automated docs, well, you're not going to be able to do the automated docs. So ensuring that you're collecting the data at the right time is, I think, a critical component, regardless of how big or small you start. But I, again, do go back to that. Hey, start small. You got to start somewhere, and you do have to leverage that. I love that tribal knowledge for the users that have the experience, and make sure that they're part of the process as well. This is not technology. Automation is not like a technology project. It's a business process project. So make sure those people, like, the insight that they're going to be able to provide to help you get to that solution is critical. So keep them involved from the beginning.
Fantastic, great feedback. So couple follow-up questions. I'm gonna point them towards David. So one of the things that Lynette said earlier on, she said, you got to get the deal off the street, right? Like you want to get that approval out, you want to get the docs, ideally signed and whatnot. But then Jordan brought up the point of like getting all the data needed, so you can generate the docs is critical. And to some degree, they seem somewhat contradictory to me. Like you want to get that approval out and you want to do it fast, and you don't want to bother them with getting a whole bunch of data, but then you're going to get stuck at the doc process. What are your thoughts from a process or technology standpoint? How do you address that? How do you deal with those conflicting needs?
Yeah, I think taking an approach from getting the right information from the right person at the right time is really important. So if someone is using your platform and they just want to get a quote, there's no need for you to provide a full application and ask for, potentially financial statements or something crazy for them. So thinking about the end user experience of, okay, now I've gathered this information to provide a quote. On the next screen, after they've accepted that quote, I can now ask for more information, and I can explain that I need this more information to get them a fast credit approval. So from the borrower or user's perspective, you are delivering something back to them or incentivizing them to continue the process, but you're not providing them an experience where just dump all this information into my system right now, so that I can automate it end to end. I think, the starting small thing is also important. So even for transactions where it is an FMV muni deal in California or something, you should know that pretty far in advance in the process. So you can dynamically adjust your stipulations, which would be automation, within your system, so that the doc person is prepared well in advance and they have a very easy process when it does time to request docs. So it doesn't have this onerous manual feeling to the end user or the vendor, and they're still getting a good experience.
Right. Well, fantastic. So any closing thoughts on docs? Again, this was a big one. Anything that we didn't talk about that do you guys feel the audience should know about automating docs? Any tricks or final thoughts on this topic? Okay, so now we are open for questions. And so I believe that the webinar chat should be open. And I believe you could post your questions there. So we'll hold tight and see what comes through. So as we're waiting, I'll ask one to the team. I said I wouldn't use the 2-letter acronym for artificial intelligence, but have you guys seen anything in practice? I mean, Lynette or Jordan, with what you guys are seeing today, have you seen tools being utilized now that are using AI to automate?
I did see Jordan take a drink when David said AI. So I wasn't sure if we were making that a drinking game for the webinar, but I would say we're watching really closely as some of our partners, we're using AI. So some of the providers that we're using, we're taking opportunities to pilot different things with, chat bots and, things like that. But AI it's a super powerful tool. I'm a big fan of, Copilot, but you've got to also, I think it's again, start small, step into it easy, because every AI tool you use says, hey, double check my work. And so I think we're probably just not in a place to sort of take it as gospel, but I think it can really help perhaps make recommendations. And when you think about a deal that might be coming off the happy path, I think there's really opportunities for AI then to help a team member to say, hey, here maybe are some recommended next steps on it. So I think that could be a really cool place to use it, in addition to, thinking about how your data providers or technology providers are using it in their platforms.
Yeah, I agree with that. The last comment specifically, Lynette, and David mentioned it. There are a lot of fraud prevention technologies that are leveraging artificial intelligence. I think there are a lot of other supporting vendors that are using like machine learning to help gather data that helps support decisions. But yeah, I don't think I've not seen any implementation of artificial intelligence that directly impacts the lending process. It seems like it's on the periphery of supporting technologies that help you make good decisions.
Yeah, supporting technologies and augmenting, and I'm sure it's going to be fast coming, right? It's just a matter of time, but interesting perspective. So we've got a couple questions that came in. So the first one is, what specific strategies can equipment finance companies use to encourage vendors and borrowers to use and embrace self-service platforms? So kind of, we talked about it a little, but any other pointers that we didn't talk about as far as like allowing, like what tool, or how do you entice them to use the self-service platforms that you've invested so much in building?
I mean, I
think we talked
David.
Go ahead, Lynette. I think Lynette talked about designing for the user experience for those people in order to get them to use it. I think one thing that I've seen effective that we haven't talked or spoken about is incentivizing it. So knocking off decreases in rates for providing additional information up front, or signing up for like auto ACH and things like that up front, to avoid having someone enter that information on the back end. Another one is for like vendor and broker programs for points or incentives, like financial incentives for following a specific process.
Mhm.
And I think
Great.
just continuing to align that to their processes, we're in an interesting time. You see a lot of private equity companies coming in to these equipment vendors, and they're looking for efficiencies. And so, as you're talking to an equipment vendor and they're saying, I need to make my application process more efficient, I think there's just a real opportunity to say, great, I've got some tools that can help you do it. So you're talking really at the C level, right, with an equipment vendor when you're thinking about creating those efficiencies and, driving expenses down for them. But then being able to talk about that all the way sort of through all the levels. So at the C level, but then also it might be a lease admin or, a sales rep at an equipment vendor's location, talking to them about the benefits. And it's a repeated message, right? What do they say? It takes 7 times, to hear a message before you really get it. And it is that balance between repeating the message and nagging, but when they're calling in at 6 o'clock at night and they've had to leave a voicemail or they've sent an email, after hours, and you didn't have a person there to help them, that's just a really great opportunity to come back and say the next morning, hey, super happy to help you get this deal in. By the way, did you know you could have had this deal in the credit queue? By the time I got you called back, you might have had your answer, right? If you had done some self-service and got that application in. So just showing them the value of the tools.
You don't just give them your phone number and say, call me 24/7. I'll key in the app for you any day, anytime.
Trying to get away from that. So it can be an exceptional customer service experience, but boy, the minute they get your voicemail, they're not going to be happy.
Yeah. Well, before we built our Aurora portal, we did do some vendor interviews, and the number one thing that came out on vendors being like why they weren't using them or frustrations they had with portals is it need to save them time. I mean, I think that's the big thing is you can't shift the lender work to the vendor. You have to make it so by using the digital experience, it will save them time and they can sell more equipment. You can't shift your work to them. Okay, I'm going to move on to the next question, which is in regards to scorecards. So how are you creating these scorecards? Can you describe the process of scrubbing data? Is it something like automating an API connection? And we've got 2 minutes. So maybe a quick, a rapid fire on this one.
I would say to address the connectivity is definitely or generally APIs, right? That's getting live data from a credit service provider on the spot. As far as scrubbing the data, not 100% clear on the question, but if you have data from historical information, that's where the scrub comes into play, and evaluating that, but then actually implementing the scorecard, I think is where the API and the connectivity comes into play.
Yeah. Well, great. Well, if you guys have more questions for the panelists, route them through us here at Nortech, and we'll make sure we follow up with everyone. So, hey, that's it, guys. We thank you so much for this great discussion. Lynette, thank you. Your feedback was amazing. Jordan, you as well. It's always great to hear your thoughts with your experience. You had so much value, and David, you as well. Appreciate you coming at it from a product standpoint. So thank you all, and have a great day.
Thank you, Christian. See ya.
Yep. Thanks all.
Thank you.